ICICI Prudential AMC closed the first quarter with robust top-line numbers, posting a 23% year-over-year growth in net profit. Looking at sequential performance, the numbers remain strong. Profit after tax climbed 26% compared to the preceding March quarter. But this headline success masks a sharp operational headwind. Between March and June, employee benefit expenses spiked by 45%. For a mature financial institution, quarter-on-quarter operating expenses generally remain stable. A sudden surge at this scale puts an immediate squeeze on core operating margins. Asset management is a high operating leverage business. If internal costs inflate by nearly half in a single quarter, the margin should compress. Yet the firm absorbed this friction and maintained its profitability. Structural operating leverage in asset management operates on a simple principle. As assets under management grow, revenue should scale significantly faster than fixed costs. This creates a naturally widening profit margin. The headline AUM growth is a distraction here. The Q1 profitability was preserved by the underlying composition of the firm's assets and mark-to-market treasury gains, rather than core operating leverage. To evaluate the actual valuation of the AMC, we have to bypass the headline revenue and dissect the P&L statement line by line, isolating exactly what protected its 81.8% profit before tax margin. The foundation of the top line is a quarterly average AUM of 11.17 lakh crore rupees, representing an 18.3% year-over-year expansion. Breaking down that growth reveals a highly asymmetric profile between asset classes. Equity QAUM showed intense strength, reaching 6.31 lakh crore. A steady pipeline of 4,872 crore rupees in monthly SIP flows drove this expansion. Meanwhile, the debt AUM experienced mechanical downward pressure. These debt outflows were driven directly by corporate redemptions, triggered as systemic liquidity tightened in the broader macroeconomic environment. Despite the heavy drag from the debt side, the firm maintained a dominant 13.5% market share in active mutual funds. The robust equity mix acted as a high-yield buffer. It insulated the firm's top-line revenue from the systemic pressures draining the debt portfolio. Pivoting from revenue to the cost structure, total expenses rose 12% year-over-year. The critical friction point sits in a single line item: employee costs ballooning from 141 crore rupees in March to 204 crore in June. This is a strategic investment in human capital, scaling the faster-growing alternatives business, and expanding offshore advisory capabilities. Institutional brokerages immediately mapped this specific operational expense inflation into their models. Morgan Stanley trimmed its target price to 3,320 rupees, citing the earnings miss on core operating profit and noting that current valuations look full. Jefferies maintained a buy rating, but cut their EPS estimates by 3 to 4% to factor in this higher employee cost baseline. Building long-term operational capabilities requires capital, but doing so creates immediate, punishable friction on core operating margins in the eyes of analysts. This brings us back to the central paradox. If core operating profit missed estimates due to an expense spike, how did the final profit after tax rise 26% sequentially? Tracing the P&L flow reveals exactly where the missing capital was injected. The savior of the quarter's profitability sits below the expense line: other income. This line item represents strong mark-to-market treasury gains generated on the AMC's proprietary investments. The scale of the swing was massive. The firm moved from a 90 crore rupee loss previously to a 181 crore rupee gain. Analysts discount this type of income because it relies on market performance, making it far less predictable than recurring operational fees. Q1 profitability relied heavily on market beta to rescue the bottom line, effectively masking the internal cost inflation from the top-line narrative. To understand why those treasury gains successfully defended to margin, we have to look at the total expense ratio, or TER, limits enforced by regulators. The market had previously priced in the fear of a TER shock, a regulatory mandate forcing AMCs to aggressively lower their fee structures. Because this shock did not materialize, ICICI Prudential AMC's core yields remained completely steady throughout Q1. Mechanically, because the core yields didn't compress, the treasury gains could fall straight to the bottom line without being eaten up by revenue losses. Regulatory stability provides the prerequisite environment for an asset manager to absorb aggressive internal investment cycles without collapsing its profit margins. Synthesizing the quarter, we see three distinct pillars: yield resilience, non-core income, and a clear lapse in short-term cost control. Despite the cost spike, brokerages like Jefferies and Bernstein maintain a bullish outperform stance, anchored by resilient SIPs and a strong pipeline. Analysts remain optimistic about lifecycle funds, upcoming contra funds, and real estate strategies. Moving forward, institutional observers will track a precise metric: the exact conversion rate of these new product launches into tangible cash flows. Furthermore, the market needs to see if the Q1 employee costs normalize or if they signify a permanent reset to the baseline operating margin. ICICI Prudential's first quarter demonstrates exactly how a mature asset manager uses a diversified revenue mix and robust equity yields to successfully mask short-term operational cost inflation.